Well, debt markets shaping up firmer after weak economic data in the United States did seem to increase the demand for fixed income assets. Let's chat about this topic pretty broadly today with Sally Old, interest rate strategist from JP Morgan in Sydney, and also in the studio with us today, Stephen Nash from FIG Securities and Carson Scott joining us too. Sally, can we start with you? Ben Bernankes' testimony, a semi-annual testimony to Congress this week, is likely to be a market-moving event. What's the chance he will actually signal more quantitative easing in that speech?
Good morning, Brooke. Look, we don't actually think that there's a good chance that Ben Bernankes stands up there and really signals an intention to ease policy further and do more quantitative easing. I mean, I think there's no doubt, and particularly when we saw the minutes from the FOMC meeting last week, there's no doubt that the Fed is probably a little bit disappointed, where the economy is right here and now relative to its expectations earlier in the year. But I think broadly Bernankes is going to run with a story that still sort of says that we are pretty optimistic that the recovery is in train. Yes, we've hit a bit of a soft patch and growth momentum looks like it's moderating, but I think the story will be that it's certainly not the beginning of anything sinister like a double dip, and we just need to we need to let sort of time play out and things sort of motor along, and eventually as we move into 2011 and 2012 we are going to start to see that unemployment rate come down. So we don't expect him to be nearly as dovish as perhaps the market expects, and I think maybe there's a chance that some more optimistic commentary from the central bank governor in the US might sort of spur a move towards higher yields in the Treasury market and hopefully higher prices on stock markets.
From what you see of the US economy and the data coming out of it, do you think that there should be more quantitative easing? Whether you think Bernanke is going to signal that or not, is that something that's needed?
Well, I guess it sort of looks, a little bit like a duck swimming on a pond. I mean, on the surface, it doesn't look like much is going on, but if you sort of think about the inner workings of the Fed, I mean, effectively what they're doing is, they've basically delayed any sort of exit strategy or any sort of normalisation of their balance sheet or anything like that. So, in effect, they are sort of being proactive, I guess, in a negative sort of sense in terms of policy. So they are actually doing something, even though it doesn't look like they're doing very much. So I think for the time being, given their sort of growth and inflation forecasts, I think that they're pretty happy that that's enough. And so we certainly at JP Morgan, even though more QE is obviously an option for the Fed should things deteriorate beyond their expectations, we certainly don't think that's something to expect in the near term in the US.
You talk about the demand story and perhaps a push up, Sally, on those yields, which have really come under pressure both at the short end and the long end. Stephen, if I can bring you into that one, there was a view overnight that a supreme test is at hand now in the US Treasury market. You also had a kind of a perfect storm with a Chinese official out overnight saying that China has to diversify its holdings and move away from just that kind of overweight US dollar-denominated debt. What will happen in this environment with those yields really under that pressure?
There's always been a concern about the Chinese diversifying their debt holdings. I think to some extent they're one of the important players in the US Treasury market. But the underlying picture, I think, is really determined by the economic outlook. We have US two-year yields lower than the crisis low. They're not there for fun. They're there for a reason, and the reason is that market participants expect policy to be lower for longer. Initially, the market thought, well, we'll have a dip here, then they'll tighten policy, and we need to have two-year yields higher. But now the market's accepting these lower yields for a very important reason. I think people should be focusing on that.
So you think demand will hold up, or will investors inevitably spread the net and look elsewhere? And if so, where?
Yeah, no, I think the view at JP Morgan is that, even though obviously there's increased supply in the Treasury market, there's also increased demand, and, some of the regulatory reforms we've seen globally over the last sort of 12 to 18 months mean that banks are going to hold more Treasuries on their balance sheet, and there's a definite sort of flight to quality story unfolding in the US as, I guess economic uncertainty rises. But the other thing to remember is that, on JP Morgan numbers, the actual net supply of spread products, so, whether that's mortgages, securitized paper, corporate supply, all that sort of stuff, is actually going to be, significantly lower over the next sort of 12 to 18 months. And so that should mean, residually there remains good demand for Treasury paper. So, I don't think the Chinese have any sort of desire to cause sort of ructions in the Treasury market that would be, against their own interests. And I suspect, as Stephen said, what is effectively happening is a repricing in the US Treasury market. People are saying the Fed's on hold for longer. the growth environment is probably going to be, a little bit worse than we thought it might be over the next couple of years, and the inflation story is certainly not remotely threatening at all. But having said all of that, some of our analysis suggests that even when you take into account sort of revised growth expectations and revised inflation expectations, yields still look too low at current levels. So we're pretty happy to be bearish or short the very front end of the US curve, particularly in that 2-year sector.
Stephen Nash from Fixed Securities, you want to add to that again?
Yeah, well, I think concerns about the Chinese are very similar to the old concerns about the Japanese. I mean, for 20 years we've been worrying about, will the Japanese sell all the US Treasuries? Did they ever do it? No. I think a similar case will be made for the Chinese. People will be concerned, but I imagine that it won't cause a major problem to the Treasury market.
In terms of a safe harbour investment, though, with all these rating downgrades when it comes to even Europe's economy, and you think of even California, its rating profile is hardly rosy.
Yeah.
Now, at what point does it take for an investor of that magnitude to say, all right, gold is a more attractive safe harbour, we'll go in there? It's still a US-denominated asset, dollar-denominated.
I think one of the things that attracts people to the US Treasury market is the liquidity of the market, and I think that will continue.
Well, those ETFs are really adding to gold's liquidity.
Yeah, well, I still think that the liquidity is attractive, and also the US still remains the world's largest economy. So I think people are attracted and will stay with it for that reason. Yeah.
Okay.
Can we ask you about Europe as well and the Hungary situation, which has been a concern for markets? Stephen Nash, do you think it is actually a threat to Europe's outlook?
I think it indicates that there may be limits to the amount that governments can cut. I think that the Hungarians have been already cutting quite substantially, and that what they don't want to do is go into more severe measures right now. So that I suppose, stand by the Hungarians may be adopted by other European countries as well, and may lead to more market concern. There's a possibility, I think, of other countries, particularly with the rating differential, Moody's and S&P, we put on downgrade, particularly Italy and possibly Spain as well.
This all feeds into reform of the space with the Dodd-Frank Reform Act of Wall Street. Tell us about that, because it comes, of course, in this key week for financial reform. Barack Obama signing that one into law Wednesday.
Yeah, well, I think it's not going to be particularly positive for markets, because I think that effectively this act will reduce the quantity of credit and increase the price of credit at a time where US growth is possibly emerging out of a recession, but may go into a double dip. So I think the reform itself is praiseworthy, but the timing is possibly a little bit difficult.
It's fair to say that actually demand is not even necessarily what it once was, though, in fairness. Look at mortgage application data out overnight. That's falling back. The consumer is almost self-correcting. Yeah. Is that a fair comment?
Well, you can expect in a double dip scenario, or where people are concerned about growth, they're going to be more conservative, and I think that's occurring within the US right now. I think there's other implications for the Dodd-Frank Act as well, but things like, how does a bondholder sit within this new liquidation procedure? Hasn't been tested before. Bondholders might be concerned about that.
Sally Old from JP Morgan, how comfortable do you think bond traders and bond markets are about some of the changes that will flow through from this act?
Well, I think it's sort of interesting, and this is where, economists and traders are sort of struggling to find, what the sort of the new world looks like, and therefore, what a new sort of long-run equilibrium rates for the US economy, because, as Stephen was rightly saying, this is going to impact the supply of credit both in a qualitative and a quantitative sense. So that sort of ultimately means, lower rates of nominal GDP, and to the extent that, over the long term, a 10-year or 30-year bond yield should reflect some sort of expectation about where nominal GDP is going to be. That probably, as we were saying before, explains part of the reason why we've seen such an outsized rally in that part of the curve. So, look, I think there's no doubt that this is going to be some sort of a constraint on the growth story going forward. But I guess the sort of trade-off that policymakers and the industry as a whole have sort of made is that this is sort of one of the necessary evils, on the back of the crisis, that we have to accept these changes and maybe accept a lower growth profile, in order to shore up the financial system and make sure, we don't sort of set ourselves up for a similar sort of event at some point in the future. So it's sort of like, shaving growth numbers over the long term in order to sort of prevent, or we hope prevent, some sort of short, sharp and very, very negative shock to growth at some point in the future. So think of it really as a bit of an insurance policy. You pay now to prevent something horrible happening down the track.
Sally Old from JP Morgan, thanks so much for that, for your analysis today, and Stephen Nash from Fixed Securities in studio with Carson Scott.